Yeah, so the recording is on is now. So anyone asking a question, that's going to be recorded. So this is week number 12 of the 12-week introduction to different property investment strategies. So we're going to do like a summary, a little review of what we've been looking at over the last 12 weeks. And probably maybe more questions than usual. And it's opportunity as well for those of you maybe watching for the first time, even though this is the last one, and we'll be going on to different content over the coming weeks. It's a good opportunity to review the different strategies, and maybe either if you haven't started investing in property, decide which is a good thing for you to do. Maybe to get more education, learn more about, or if you're already doing property, maybe there's some new things that you think will be useful to have a go at. Again, get more education and start. It's always a question of education and then taking action. So let's move on. So a very fast overview of property investment fundamentals. So what is property investment? So it's acquiring property to generate financial returns through both income. So when we buy for example, a buy-to-let, we're renting it out and we're getting ongoing income, and the income minus the interest that we're paying on our mortgage and other costs. That's the cash flow. And obviously, we're always looking for positive cash flow and as much cash flow as possible. And then the other thing that we're getting from property investment is capital appreciation, the value of properties increasing over time. A couple of notes on here. If we're buying a property to renovate, convert and resell, although it is like property, we're considering this, or I'd like sort of considering this more like a business, because we're actually involved in, it's almost like a trading business. We're buying something, improving it and selling it to get the profit, but we're not like doing it as an investment for holding and for long-term income and capital appreciation. However, and this is a second note, if we're buying a share of a property, and we do that quite a lot, either through joint ventures or what we've got, which we call the pooled BRRRR, a share in a property where it's a share to buy part of a property with other people with the aim of holding on to the property. That really is a property investment for both again, the income and the capital appreciation. And generally both at the same time. Why invest in property? So compared to other investments, property is stable. I think if we're comparing, for example, with crypto, which can really go up and down, property is stable, generally always over time, increasing in value, some small dips, and then carrying on increasing in value. So property as well. We've got the income generation, capital appreciation, and we can use leverage. That means if we're buying a property, we can buy it 100% with cash. Let's say property is £100,000. We've got £100,000 available, we can go out and buy it. If we don't have that money available, we can borrow from the bank. Typically, we can borrow 75% of purchase cost. So we only need 25,000 of our own money to get into a deal that's worth 100,000, obviously a bit more because there's costs and things with it. So that's a really good thing with property investment. And we did look at 3 key metrics. Again, not going into any details, but always try and have these in mind. Whatever strategy you're doing, return on investment, that's the return on the actual amount of money that we put in a deal. So if, for example, we just spoke about putting 25,000 into and then using bank lending, the return on investment is the return that we get on that 25,000 that we've put in or left in the property. Yield is independent of the amount of money that we put in a property. Yield is the amount of money divided by the value of the property. And in different areas, we get higher yields. And cash flow is when we've got our income every month, taken all the expenses away, the cash flow is what's left is money that we can either accumulate to reinvest, or money that if we're doing it for ongoing income, for living, then we can use that money to spend as our income. So we're going to go through 10 strategies. Some of them are like parts of a strategy or options of a strategy, and some of them can combine together, especially when we're going to be talking about creative strategies like purchase lease options or vendor finance and things like that. We can apply any of the creative strategies on the different types of property, like it could be a BRRRR deal, it could be a commercial to residential conversion, it could be an HMO, it could be a pure commercial. We can still do if the vendor obviously is agreeable to that and it works for them, do lease with option to purchase. So the BRRRR, or we like to call it BRRRR, which is buying below market value, renovating a property, and generally using some strategy to add more value than the cost of the works. Very typical example is when we've got a 2-bedroom house with one of the bedrooms quite large. We can divide that large bedroom, as long as obviously it's got 2 separate windows, into two bedrooms. So we convert a 2-bedroom into a 3-bedroom. Adding a bathroom, for example, an ensuite, can add more value than the cost of it. And yeah, things like kitchens, bathrooms, different things. Sometimes also converting a house with 2 bedrooms, if sometimes we can convert that into a 4-bedroom HMO if you've got a couple of reception rooms on the ground floor. So the BRRRR, buy, renovate, we're renting out to get the cash flow, and because we've created a property with a higher value, we can refinance at the end. That means we can go back to the bank and say, based on our higher value, can we borrow based on that high value? And in a lot of cases, we can get most of our money out. Generally, we're talking about leaving in the deal on a typical BRRRR something like 20 or 15% of the deal. When it's a deal where, as an investor, if you're doing all the work to find the property, so you're doing the sourcing yourself, you're going to be then, if you're project managing the renovation, you can get to deals where you're leaving probably 15, sometimes only 10% of the money of the purchase price in. If you're paying someone else to do it, that obviously is something that we do. We do the portfolio building, which is finding the properties, managing the renovation. In those cases, you can still have good deals, but there you end up leaving 20% in there. And we've got the variation on the theme, which is we're also finding BRRRR properties to renovate, and we're doing them with the pooled BRRRR, which means multiple investors can come in and join with us or join together on one project and get all the benefits from it, in the same way as if they had the money to put in and buy a complete project. So the BRRRR, in reality, it really is the, let's say, key entry point for, let's say, serious property investors. And the BRRRR is already one step further than someone who is buying a property that's already ready to rent, potentially already tenanted. Because when we just buy a property at close to market value and rent it out, yes, we're getting the income. Yes, over time, we're getting the capital appreciation, but we haven't added value. So all the money that we put in there is, let's say, stays stuck in the project, whereas the BRRRR strategy enables us to have our pot of capital, put it in the first project, 6 to 9 months later, get 80% out, ready to do the next one. So that's the BRRRR strategy. This one, rent to rent and rent to serviced accommodation. It's a bit of a, let's say, if all the other ones are square pegs, this is the round one. Or it's like a little different in the sense that our rent to rent and rent to serviced accommodation generally are strategies to use someone else's property to be able to get reasonably fast ongoing income. But the aim here is it's not buying properties, so you don't need the capital to buy them. But at the same time, as you're not buying them, you can get the cash flow, but you're not building up a portfolio with equity and capital potential for capital appreciation. But it can be a good way to start if you have a lot of time to be able to find the properties, to be able to manage them. And what it is, rent to rent is renting off a landlord at a fixed rent a property with the agreement that you're able to sublet, typically like as an HMO on a room by room basis. And rent to service accommodation, pretty obvious, it's renting at a fixed rent from a landlord a property and then renting it out on Airbnb. There's a lot of things. This is quite management intensive. It is possible to pay someone to find one. So there are sources that will find rent to rent properties, possible to pay someone to manage them. But if you're doing both of those, at the end of the day, you're not going to make that much on it. It's only good strategy, and you can get 500, 1,000 cash flow on a property if you're finding it yourself and doing all the day-to-day management yourself, but it does take time. But it's also possible using this, if you have time, maybe build up 3, 4, 5 rent to rents, get 2,000, 3,000 cash flow per month, and accumulate that and use that as a deposit for the first BRRR project. But in the same way, it's almost like a job, but it's can be quite a profitable one, a profitable thing. And also, obviously, at the same time, you're getting an understanding of how property works. You're speaking with landlords. So yes, it's okay to start with, but in practice, real property investment is building up some capital to start owning property and benefiting from all the aspects of property investment. Before we move on, are there any immediate questions? I'm happy to answer any questions as we go along.
Yeah, I've got a question. So, in terms of the buy, renovate, refinance, and rent out, what is the? I mean, in your experience, and what is the average capital one should obviously put together to be able to start?
Yeah, so on let's say the lowest cost properties, where it's possible to get properties that cost maybe 40 or 50,000 in areas like around Sunderland, up in the northeast. But on these properties, generally, it's not possible to add sufficient value to be able to get most of the money out. And there's not much potential for capital appreciation. So we're more talking about areas like people know that I do stuff in South Wales, but areas like parts of the Midlands, like Stoke-on-Trent, for example, going up towards Liverpool. We've got similar priced properties where we can buy a house for around 70,000, pay 30,000 renovation, so 100,000 of money in order to get an end value of 120,000, which means 90,000 out. If you have that full amount, like 100,000, it's ideal because you can use that pot, go straight for it. Also, sometimes buy properties in auction, which is a good way, and then refinancing at the end. If you don't have that money, possible to start with probably something like 40,000 in reality, and use bridging finance, so which is basically short-term lending for up to 12 months to be able to buy the property. So it's possible to borrow 75% of the purchase price, but you still need to add on top of that the fees and the stamp duty and stuff. And then the lending on bridging will also pay for 90 or in some cases 100% of the renovation costs. Yeah, so basically you need ideally, well, 40,000 of your own money to get a full BRR. But remember, we've got the pool BRR where from 5,000 you can invest with other people, but under our like structure and our control, so everything's done properly. And also get into that. Does that answer your question?
It does. Well, just based on your, explanation there in terms of that example that you just gave, if I had 100,000 and I could actually afford to buy one property, I think previously when we've discussed that, I think you've mentioned things like leveraging banks as well to maybe basically split that into maybe a couple of projects rather than just the single one.
Yeah, the again, it's always the question of yeah, also how fast do you want to go? You're able to go if you're managing it yourself.
Yeah.
Probably, I would still recommend if someone's got 100,000 on the very first one to not use lending to buy it. Use that money and buy the first one rather than buy two.
Okay.
Understand the process. Do it fast. Start looking at the refinance before you finish. Don't wait until it's rented out because you've got 2 or 3 months to sort out the refinance. Start looking at that almost as soon as you bought the property and you're starting the renovation. And then if you do the first one, and let's say you get 90,000 back out from it, then consider dividing that into two and the next time doing two to speed things up.
Okay. So what is
And the
the
thing as well is when you do two, or when you use lending at the beginning, with all the interest costs, finance fees, broker fees, etc., you're probably losing 5,000 on there, which again is a question of if by in inverted commas losing that 5,000 and doing two at the same time is potentially faster because you're cash flowing faster and you can put that in an Excel. And as well, if you've got the appetite to do that and the energy and the time, then yeah, use leverage at the beginning.
okay, so yeah, it's more down to doing your due diligence, really seeing what's beneficial in terms of
Yeah,
whether you
and
go.
also the other thing is if you've got 100,000 ready to go, rather than that can also give you, because I said if you're using leverage, you're going to spend 5,000 in bank fees and broker stuff. You're also potentially going to miss out on some of the best deals because if you're buying stuff in auction, it's difficult to get bridge. You can get bridging easily in auction to cover the purchase costs, but not the renovation costs. And also, if you're doing a cash purchase, you can sometimes, in fact, often negotiate 5,000 on the purchase price.
Right, okay, okay.
So in reality, by buying cash, you can actually save in
Save,
save
yeah.
inverted commas. Because if you're saving and wasting a year doing stuff is not saving, it's wasting money. Um,
Yeah. Right.
yeah, it's a faster way of getting into it. The same when sometimes people are doing renovations and they've got some quotes and they think it's going to be too much and they dithering around for 3 months getting trying to save £2,000 on the renovation costs. If the builders are reliable, just get it done and get it cash flowing.
Yeah. Okay.
We had an example, I think it was last year, where someone asked as we with our build team we did a quote. We're not the cheapest when we do quotes because we obviously do things properly. We've got our project management fees because we're looking after everything. So our quote probably was maybe 3,000 more. This was on like almost a 30,000 renovation. Our quote was maybe 3 or 4,000 more than the person who bought the property thought that they ought to spend. So they looked and sorted out with other builders. However, 6 months later, they came back to us and said, finally, it doesn't really work out. Can you do it? And we said, yeah, we can do it. We can do it still at the same cost. So in reality, they paid the same amount that we'd originally quoted, but they lost 6 months. And 6 months is, if you're thinking of this actually was a cash purchase, so they didn't lose interest. But 6 months at 800, let's say, of rental income, that's more than what they would potentially have saved.
Mm-hmm.
Yeah, so just get in and get stuff done fast, but with proper due diligence.
Yeah. Okay. Thank you.
Right. Yeah, I'll move on to the next ones, and then we can take more questions. So yeah, rent to rent, rent to serviced accommodation are like sort of not full on property investment, but a good way to potentially get started. And we can help people with training on those strategies as well. I've done rent to rent. One point in time, I had 12, this was before COVID, 12 rent to serviced accommodation. COVID killed that, but I've still got a few rent to rent on that we rent to HMOs. Not that we were specifically searching, but people said, look, I've got a house, what can we do with it? And we said, okay, happy to take it on, we'll give you the market rent. You know us, so we don't need to bother with a deposit. And yeah, it works out fine. So next one. Maximizing income from buy-to-let investments. So this is a reminder that our standard terrace house that we're buying with the BRRRR strategy, we can do standard tenancies, so standard buy-to-let in there. And sometimes it can be the best and easiest solution. Find a good tenant, take out the rent guarantee insurance, and have a agent managing it, or self-manage it if it's not that far away, and just get the income with very little hassle. Highest yield is if we can do serviced accommodation with it, but more management. And then think about some of the really good ones, HMOs, renting out by the room. We get higher income. Also, at the same time, we're paying the utilities, so we got higher costs. We're paying the council tax and things like that. And then we've got social housing and supported living, which are similar. Social housing is like, for example, refugees, or it could be, and these are all on 3 to 5 year leases. It could be the local council or housing authority renting the house for homeless people. And then supported living is also long-term leases. So, and when these are long-term leases, people taking them on, the companies taking them on, are looking after the maintenance, which is a good thing. Supported living is for people with special needs. So yeah, bear in mind when you're looking at properties to buy, if it's a BRRRR property where you can make it into a 4-bedroom HMO and it's in an area where that works, a bit higher cost for doing the renovation because there's higher standards like fire safety, but still definitely worth doing. On the templates that we use and that are in the full BRRRR training that we do, those templates have all the like purchase and renovation templates and stuff. But we've also got the templates for calculating the costs and cash flow as a standard buy-to-let. And we've got the templates for calculating that if it's operating as an HMO or if it's operating as serviced accommodation. Now we're getting into I'm going to say creative strategies. Joint ventures is not specifically a creative strategy. What a joint venture is where we've got an experienced developer who's found a good project which has got a good profit. Sometimes it can be all of the money out or good profit followed by really good ongoing income, things like commercial to residential conversions. And there, the key thing is that there's a really experienced investor who's found the project, is looking after everything. Obviously, it's always needed money in a project. Even if the bank's lending, we need 25% at least for the deposit and different costs and things. And that's where the hands-off investors come in, are putting that money in, taking shares in the company that owns the property, so taking some equity. And either there's two types of hands-off investor. There's a hands-off investor who just knows that property is a great thing, trusts it and has done his due diligence on the developer and just wants to put the money and get his return. And then there are those that come into a joint venture because they're interested in property, interested in doing it themselves, and they're using it as the earn and learn. So they're learning, because when people come onto a joint venture, they have, well, the ones that we do, of course, others probably is generally similar to some extent as well. People that come onto a joint venture have access to understanding exactly how the finance works. Obviously, they can see the accounts, understand where the money goes, what the different costs are, and also see how we deal with planning, building regulations, and then how we, if we're doing like service accommodation, how we're sorting all that out, which can be experienced for them potentially down the line to go on and do the same thing, or if they realize that there's a lot of stuff involved in it, say that's great, but we'll take our money that we get out of this one and we'll come back in with you on another joint venture. Obviously, joint ventures, it means need to be comfortable in doing things with other people, and also do proper due diligence, understand the people, well, especially the developers, what their experience is. Yeah, ask other people that have worked with them before what they're like, and understand if you're comfortable in doing that. But yeah, joint ventures can typically offer higher returns than the standard BRRR or the pool BRRR, because these are bigger projects with yeah, higher overall returns. Now we're talking about creative strategies that can apply to, in reality, any type of property. So if we're buying a standard buy-to-let, we're buying mixed use, which is like shop and flats above, or we're going to do a commercial to residential conversion, we're buying a commercial property. A purchase lease option is when the person selling, they don't need the capital or the money for the property straight away. Maybe they've got a mortgage on it and they need to be able to pay the mortgage. Maybe they're fed up of managing it, or they want to have it off their hands. And there, what the win-win is that we're proposing to the owner saying, look, we'll take over the property from you. We take an option to be able to buy it at the price that the owner wants, but in, for example, 5 years' time. And we'll say, look, we're going to be paying your mortgage. We're going to look after the property. So everything's covered, maybe pay a bit more than the mortgage. And that enables us to take control of a property, but actually getting the money later on to buy it. And generally the principle is we do our calculations such that by the time we're ready to exercise the option, we'll have added sufficient value to the property that at that point we can refinance and get out enough money to be able to pay what we owe to the vendor. And then there's variations on the theme of purchase lease options. Variation number one is exchange with delayed completion. Difference there is exchange with delayed completion. The delayed completion can be 5 years down the line, but we're committed to purchase at the agreed price within a certain time. With the option to purchase, we're not committing to purchase. People can say, why would an owner accept that option? In practice, we explain to the owner also that we're going to be doing work on the property. We're going to be increasing the value of the property. So in reality, if we don't exercise the option to purchase, A, we're probably stupid. And secondly, the owner will have got a property that's worth more, that he'll be able to sell more, and actually potentially for more than the option to purchase that we've agreed on it. And vendor finance is when the vendor sells the property but doesn't take all of the money, maybe takes half of the money, and the other half of the money is consented as a loan to the people buying it. So that sits as a loan on the accounts, generally a second charge on the property, and we need to pay that within a certain point of time. So understanding fully the creative strategies can really be a great way of getting property without massive amounts of capital. The only thing is in general, these ones, you need to find them yourself, because if, for example, if someone asks me to source for them a purchase lease option, I'd probably say to them, well, why, if I got a good purchase lease option, why am I going to sell that to you? In reality, it's not as clear cut as that, because sometimes with the purchase lease options, we might still be agreeing with the owner. Let's say, for example, on a property that's worth 500,000, we're still saying to the owner, we'll give you 50,000 up front. Maybe the owner actually needs that to pay off some debts that are not related to the a charge on the property. In that case, I might say, look, to an investor, come in, put in that I've got this purchase lease option, put in that, first of all, at 50,000, we'll agree on the other terms and we'll both take a share in the deal. Also, the way that we can help on that is, because obviously I've got the experience in doing these, people that are looking to do them can come to me for advice or come and join the mentorship schemes, and get the guidance to find them, what sort of filters to use, how to potentially find properties like that. Obvious thing is looking for properties that are both for sale and for rent at the same time, and the other thing is to know all the right questions to ask and the right approach to the landlords when you're viewing the properties. So these are creative options to apply to any different type of property. HMOs, we've spoken a little about. HMO is when we've got a house that we're renting out by the room. It can be what we call a mini HMO, which is 3 to 4 tenants, 3 to 4 rooms if it's one person per room. Unless we're in an Article 4 area, we don't require a license for that, but we still have to do all the compliance, fire doors, emergency lighting, interlinked smoke alarms, fire risk audit, and all the standard and important stuff. If we're talking about what I call standard HMOs, there is 5 or more tenants. That is mandatory licensing across the UK, or at least England and Wales, because I'm not doing anything in Scotland or Northern Ireland, and I know the rules are different there, specifically in Scotland. So we have to apply for a license for HMOs 5 or 6 tenants, also for 7 or more. But I talk about standard HMOs because when we're talking about standard HMO, we're almost always having a valuation of the property based on the bricks and mortar. When we get large HMOs of 7 or more rooms, specifically if all those rooms are en suite, then we've got a property that we can't easily say we're now going to use this property as a family home. It's specifically adapted, and we put quite a lot of money into make it into a HMO, and on that basis we can go for a commercial valuation, which is a valuation of the property based on the income and a multiplier called the yield, and we can get a higher value for the refinance than if it was just bricks and mortar. These enable us in areas where we've got low yields because the property prices are really high, like in London, when we can do large HMO conversions and get the commercial valuation. And obviously if we got it at the right price and we're properly doing our renovation and not wasting money on it, we can get almost all money out deals in that case. So HMOs is a really good property investment strategy. Obviously all these we're talking about residential, which means also residential renters' rights bills and changing legislation, more frequently changing tax legislation. So we need to be ready for the ups and downs of that ride and be on the ball, or be with people that are helping us follow all of that. Title splitting also is partly a creative strategy, which is taking a property, like it could be a multi-block that's on one title, and if we divide into individual titles, then that means when we're doing a valuation, the valuation is based on, for example, 10 flats rather than a block of 10 flats on the same title. That'll give us a higher value for the refinance. And it'll also, if we're selling off, we can sell at a higher value because we can sell off individually. Sometimes title splitting can be a nice operation for people that like to sit at their desk and deal with paper and solicitors. And sometimes we can buy a block that's operating as multiple flats and by title splitting, add value to get, again, all the money out. Planning permission. Obviously, we've not got time to go into everything. When we're buying properties where we can develop them under permitted development, like converting offices to flats, for example, or permitted development, we can convert house into an HMO unless we're in Article 4 area, then that can enable us to add quite a lot of value. And there's also a nice thing, which is also partly paper exercise. Obviously, there's more risk here if we're buying something that doesn't have planning. Ideally, we don't buy things without planning. We take an option on them if we can negotiate that with the vendor. Even if we're agreeing to a higher price on the option, then we're sorting out all the planning. And quite often when we've got planning on a property, rather than implement that planning, in other words, have all the headaches of finding the developer, looking after the builders, selling everything off, we've added enough extra cost by doing the planning, and we can sell the property or the site with the planning and realize our profit there, rather than getting a bit extra profit, but for all the work to look after the building, unless the aim is to implement that planning and hold the property for the ongoing income, because it could be a really good cash flowing property. Each case is different and needs proper and complete analysis. Commercial to residential conversions, pretty obvious. Big demand for accommodation for people long term, where people need to live. Maybe not quite so much demand for large office buildings in probably small towns and suburbs. So buying these, converting them can add quite a lot of value. And as well, we mentioned planning, we can do this quite often under permitted development rights. So these can be great projects, and also great projects to come in on as a joint venture. I've got one commercial residential. We're just about probably going to complete on the purchase next week. We've got some shares available in this one if anyone is interested. These are shares. There's actually 50,000 of shares available. The deal on this one is that it's not necessary to buy them all, possible to buy, I think, from 5,000 or 10,000, I don't remember. Ask me afterwards if anyone is interested, or anyone looking at this, send me a direct message. The deal on this one is when we finish the conversion, we're going to be refinancing, and we're going to be holding this block for serviced accommodation. We're going to be returning 50% of the initial money back to the investors. The investors still then retain a share of ownership, ongoing income, and we're looking at, based on our projections, 22% annual return on the money that's left in on this deal. So commercial to residential, either you've got the experience and sufficient deposit money to do it yourself, or come in on joint venture with experienced developers. And pure commercial property investments. So when we're doing residential, we've got changing legislation, sometimes an unfavorable environment, because people think that landlords are all bad people. In reality, most landlords are good landlords, and they're providing a much needed properties for people to live in, but that's how it is. Pure commercial property can be, there's multiple classes. It can be retail, it can be offices, can be hotels, restaurants, can be industrial. What we like a lot is basically the commercial equivalent of an HMO. These are like mixed use industrial / office slash, let's say, dance class gyms, maybe small cafes, things like that, typically on the edge of a town. And yeah, it might be a block where there's 20 individual units, 20 different tenants. Sometimes 2 or 3 can be put together. And we're using the principle of commercial valuations based on the income. So where we can get a good below market value block, maybe not fully tenanted, we can increase the the income, obviously improve a bit the property itself, and often within 2 to 3 years get all the money out. And also a big thing is we've got long leases. It can be between 5 and 25 years on the units or on the property. They're professional tenants. If the tenant stops paying within 2 to 3 weeks, we can remove the tenant. We can just change the locks. And also we haven't got to deal with ongoing maintenance, because generally it's the tenants that are looking after it. And even the management charges, because obviously these need professional management, this can in part or all be covered by what the tenants are paying. So commercial, and there's other things like capital allowances, which reduce the tax bills, and some other tax advantages as well. So commercial property investments is really a good one to look at and to understand. We're going to be doing probably in the next few months some pooled commercial property investments, because generally the entry ticket is higher. We've got a couple that we have on the go at the moment. One is a block of offices in a town centre. This is up in Bradford in Yorkshire. I think there are 21 offices. It's currently fully tenanted. This is at around 750,000. And then we're looking at a in a similar area in the northeast, a multi-unit block that's around 1 million. But both of these, it's all money out on refinance in around 2 to 3 years. And we're talking about return on investment initially starting at 10% and going up to around 20% over 5 years. So it can be really good opportunities. And also commercial property investments, people who have SAS, which is like a small self-administered pension scheme, can invest in commercial property. So there we've covered a lot of things, like a recap on the different strategies. Let's see if there are any questions or comments, or maybe someone would like to say what they're like really wanting to do or thinking of doing in the light of all this, and yeah, like changing things.
Trevor, quite early on, you mentioned rent guarantee insurance or rent insurance. Is that something you'd recommend these days?
I recommend it probably. It depends. If someone's got plenty, not going to say plenty of money, we've never got plenty of money. We want to always increase that. But if it's someone's first buy-to-let, and let's say the mortgage is going to be £500 per month, probably the risk of a tenant not paying, if they're properly chosen, is relatively small. Maybe it's even as low as 1%. But it's a question is it possible for that person to cover that £500 plus, let's say, potentially council tax or other expenses, if the tenant stops paying and for 6 months there's a problem and it's needed to go through the courts, pay the court fees to evict them? The risk is low, but the risk is there, and it's really important to consider that, not to just go blindly into a first buy-to-let thinking everything's going to be fine, and not understanding what is the worst case and how are you going to cover that. I personally don't take any of this for two reasons. A, I'm doing primarily HMOs, so I've probably got something like 60 or 70 individual tenants. Currently, I think there's one that's not paying. So that means I've sort of got my own insurance because I've got enough rooms or properties so that obviously statistically there's a very, very remote chance that out of those 70 people, maybe 5 or 10 are not going to pay. But even then, it's not, in my case, it's not catastrophic. So yeah, it's an individual case, but definitely on first ones, and if it's families going in there to consider it, it's not that expensive.
Trevor, thank you.
Yeah. Any other questions? I'm going to ask a question. We've got Keith here, who's actually quite an experienced investor. Keith, if you're able to unmute your microphone, what would you say for you is the best strategy out of these, or maybe other ones, going forward in investments that you're looking to make over the coming, let's say, months and years?
I would tend to go to something that's going to produce a regular income. So, I mean, myself, ideally, if I was able to pick an ideal project, it would be a mixed use with commercial on the say ground floor, typically commercial on the ground floor, and the ability to change the uppers to an HMO or a couple of HMOs, or maybe a service accommodation. So then you're getting cash flow from the commercial on the ground floors and all that, and then cash flow from the rents from whatever you do upstairs.
Yeah, I like that, Keith. That's a good recommendation. And yeah, these mixed use properties are probably on my side some of my favorite properties. And sometimes, yeah, sometimes you get them already with the flats above, and it's a question of renovating them. Sometimes you got the shop and a couple of 2 or 3 floors above the shop, which are just used for like an office or some storage. And there, that's ideal to, yeah, convert into either flats or potentially into HMO.
Yeah, like of late, I did bid for a small office building, but I wasn't successful. But that would have been ideal. That would have turned around to
Yeah.
a size like 10-bedroom HMO size with one suite, like a really nice building. I tend to not favour anything that's going to involve sales at the moment, because I know sales are a bit tricky in this present market. So I would tend to stay away from sales unless the price is really right, so that I can have more
Yeah.
on the sell price. That's me personally.
Yeah. Okay, that's great. Thanks for answering that question, Keith, and for your experience.
Yeah, thank you.
We've got time for 1 or 2 more questions, if there are any, from anyone.
I expect we could ask the other people on the call, on the Zoom call, what do they want to do? I mean, what is it they're looking to do? I mean,
Yeah, let's do that. Yeah,
Trevor,
maybe. Yeah, who's
somebody
going to
like,
unmute themselves and say what they want to do?
see you, mate, and ask him what's he want to do. Why is he here?
Well, I think I've spoken to you privately, Trevor, in terms of what I'm trying to get into. But yeah, very new to property investment. So I think we met at a networking event towards the end of last year.
Okay.
Yeah, I work as an IT contractor. I'm trying to get into property. So I said to Trevor, maybe the first thing I want to get into is to go into a joint venture and be part of a earn and learn type of setup, and go through it, and then eventually probably do something on my own, do a BRRRR with obviously Trevor's support towards the end of the year. So that's the goal for me this year.
Okay, that's great. Yeah, thanks. So I see there's 2 other people online here. We've got Vatsal And Ope, I don't know whether you'd like to each say what you think thinking of doing in the future or in the coming months out of all this.
Hi guys. Yeah, so I'm just coming towards the end of an earn and learn on an HMO in Sullyoak in the Studentsville. So I've learned a lot from that. So I am actually number crunching on some HMOs in the same area, together with my mentors that were teaching me on the earn and learn. But since starting that earn and learn, I've got a business partner now in the area. So it's we're looking at opportunities such as blocks of flats, and I actually started negotiation on a block of flats not too far away in the West Midlands today. So that person's going back to their business partners to discuss the offer, but that one will be doing a title split if we can. Just trying to line up the things with the legal people and tax people just to make sure we do things efficiently. And today I was in further north. My business partner and I were looking at a portfolio of HMOs, and that would be a company acquisition, which is a little bit new, but like quite tax efficient from a stamp duty perspective. So, and that would be a shortcut to building cash flowing portfolio if we can get it for the right price.
Yeah, if you can buy a company, if you can buy it with an option to, well, with some element of deferred payment, those are really great ones.
Yeah. So I mean, there's things. I mean, you know, I know Trevor is often whenever I spoke to Trevor, it's been like kind of like, when are you going to get started? I mean, I feel like I've gained a lot of momentum the last couple of months, and a lot of it has just been about applying the knowledge, just taking action, you know, and every conversation we've had, whether it's like an owner or an agent, reviewing we've done, or even the number crunching on deals, like, and just going for it really. I've had conversations with my finance broker as well, and he's been very helpful in terms of providing an actual agreement in principle on a number of properties that I didn't end up going for, but it gave me enough confidence to know what the likely rates
No,
are for a
that's good.
similar
Yes.
property and things like that.
Yeah,
And
that's the thing. Look at things like general for other people to know. Yeah, don't hesitate to look at things, even if you
yeah,
think there's little chance that you're going to end up taking it.
yeah,
Still do the figures and go and look at
yeah,
how you can finance it and everything else.
yeah. I had a mindset thing as well. I mean, like I was with a deal clinic with my education community in Leeds on Monday, and they're asking me how I'm funding all these things that I'm looking at, and I'm kind of saying, well, if the deal is good, the deal is good, right? The financing is the next stage, and it's solvable, right? It
Yeah,
may not be
there has to
solvable,
be a
but
good deal. Yeah,
yeah,
because if
yeah,
it's not a good deal,
yeah,
you're like almost dishonestly trying to convince people to come into a
yep,
deal that you know is not a good deal.
yeah. So the approach
Um,
I'm taking is everything I look at is something that I'm genuinely interested in executing
yeah,
myself. I'm applying the same level of due diligence, and if I can't execute for whatever reason and be part of that deal, only then would I consider offering that deal up
yeah,
to other people, but they have to be doing that strategy.
yeah,
And the way I want to look at it is that those people are potential joint venture partners,
yeah.
you know.
Okay,
So
that's great. Yeah.
yeah. And
Okay,
I've got
thanks.
my
Yeah, sorry.
SAS
Yeah,
pension in the background bubbling away, still trying to get that sorted. So hopefully do some
yeah. That
commercial. Yeah.
Yeah, commercially is definitely thing for that. Obviously, a SAS can lend to other types of property development, but commercially is the ideal for that one. It's almost 1 hour. Ope, would you like to say anything? What you're thinking of doing?
Sure. I'm thinking. Hello, am I audible?
Yeah, we can hear you.
Yeah. So, for me, I'm thinking of doing more HMO and BRRRR. But I think for me to actually proceed with doing that, I need to actually get my house in order.
Yeah, of
And
course,
that's what I mean by that is that I've got 2 HMOs that I think currently they're underperforming. Trevor, you're you're very aware of that because we are actually
yes.
you're helping me with one of them, the one in Liverpool. Currently it's been empty for well over a year. And so I want to get that up and running and generating cash flow from there. There's another one is Stoke-on-Trent. So the one in Liverpool is 7 bed. The one in Stoke-on-Trent is 7/8 beds. And the current owner of the property, I'm the owner of the property, but the estate agent managing it was the estate agent managing it for the previous owner. And so he's been paying me very, very little money compared to what I should be earning. I understand the property probably needs some updating. So I need to get that fixed and operating very well before looking to invest in some further things like joining the pool, investing and doing some more HMO or BRRRR.
Yeah, that is actually really a key lesson, is to, if you got some things before investing in anything else, yeah, optimize as much as possible, yeah, what you already have. And sometimes this is maybe not your case, Ope, but sometimes people have got things, especially I think you might be your case, but when people have got properties that they bought in their personal name, and sometimes looking at all possible ways of turning it around and making them profitable. And sometimes at the end of the day, it's needed to like sort of bite the bullet and say, I'm not saying this is your case. It's a question of like really analyzing it. And sometimes it's needed to make a decision and not hold on to something just for the sake of holding on to it. If it's better to sell and reinvest, but obviously not take those decisions lightly and do like full proper analysis of everything.
Yes, I've got a question, and the question is regarding buying property, a limited company that owns a property and buying that limited company. How does it work? Does your limited company now acquire the new limited company? How does it work in terms of saving tax? And
Yeah, generally your limited company would be acquiring, basically buying the shares in the other company that owns a property.
okay,
Yeah, or sometimes people might buy it in their personal name, because as long as there's one company in there where it's possible to hold the money. But if you've got a few properties, generally it's best to, yeah, effectively do it through a holding company. However, what is important is that when you're buying a company which owns a property, even though you're not paying stamp duty, there's a lot more due diligence and legal due diligence to do when you buy the company. And you need to use a solicitor that is experienced in buying companies. Because the problem with the company is, if let's say you're buying a company and you find out afterwards that that company owes £20,000 worth of, for example, to a supplier they haven't paid, that information isn't going to be public information. It's because when you're buying a property, if there's a charge on the property, the solicitors can easily find that by going on to the land registry. When you're buying a limited company, then it's needed to ask all sorts of questions to the current owners. It's needed to get those owners to declare officially that there aren't any debts or different things. It's needed to take out what are called indemnity insurance policies, so that if you end up opening a cupboard and finding there's a skeleton in there, yeah, like a so-called skeleton in the corporate cupboard sort of thing. If, for example, there'd been some fraud or something in the company, or that some taxes that had been declared to have been paid but weren't paid. When you buy the company, you become responsible for that. I'm not trying to make it, by the way, a nightmare. It's just I have bought companies and I've sold property owning companies, but it's needed just to be careful and to also to understand it's not going to be 500 or 600 pounds worth of conveyancing. It could be between 3,000 and 5,000 of solicitor fees to do it properly.
Right.
But then if you're saving 15, 20 or 25,000 of stamp duty, it's good. And also speed, you can do it faster than conveyancing.
Right. So do you then become the director of the company and then you remove the previous director from the company?
Correct. Yes. Yes.
Okay.
Yes. So so you as part of the share purchase, there's also like basically a share transfer type agreement, which is basically a legal deed in which on transfer of shares, the current director resigns and you or the new shareholders appoint a new director, which typically will be the same, would be the shareholder.
So in the case where the company name is being the person's personal name, like John Limited, and I don't want that, can I then say, okay, well, I want to move all the properties under John Limited to my company?
You can't
Limited
do that
company.
because you can change the name of the company.
Okay.
So if the name of the company was John Smith Limited, you can change it to 28 High Street Limited, for example.
Okay.
However, even when you change it, the history of the previous name will be on Company's House.
Right.
But you can't then transfer. In general, if you want to transfer that to a separate limited company, then that's a transfer that takes place on the land registry and you're paying stamp duty on that.
Oh, okay.
Yeah, so there are some possible ways around it when it's the same shareholders owning both companies. But there, I'm not a specialist, but there are some potential ways of like it's basically to be able to reorganize the ownership within a group of companies, and then there are some possibilities of not paying stamp duty.
Okay. Okay. Yeah, thanks for that.
All right. Well, hopefully again this was useful, covering all the different property strategies. We'll be continuing these webinars, but will be different subjects, and we'll be giving a program over the coming days. And we do have the webinar also on Thursday, where on Thursday normally there's going to be a person with me who is the person that I'm doing business partner on the commercial properties, and we're going to be interviewing him on his experience and also a specific deal that a property that he bought a couple of years ago and how he turned it around, and I think he's at the point now of refinancing that. So that will also be a really good example and learning experience for anyone that can take part in that this Thursday at 7 o'clock.
Okay.
All right, thanks. So I'm going to stop the recording, and everyone have a good evening.
Thanks, Trevor.
Yeah,
Thank
bye.
you. Yeah, bye.
Thanks, Trevor.